Good morning, everyone. My name is Fraser Lusty, and I'm the Head of Business Development at LendingCrowd. And this podcast has been produced to give an overview of what crowdlending is, and we've named it the what, the why, and the how. And this has been produced on the back of a recent webinar we did in the same space that was forward-facing to advisors and IFAs. So, the internet is changing our lives on a daily basis. If we look at the way we shop, the way we listen to music, these have been changed forever in response to the way in which the internet has been used as a channel to market. There's a growing movement afoot now to revolutionise banking, equity investing and giving by using technology to simplify the links between those who want to invest money and those who need it. Crowdfunding and peer-to-peer finance are at the vanguard of this movement. This is against the backdrop of continued difficulties for banks in terms of high fixed costs, regulatory requirements, and dare I say it, the continuing scandals of FX and LIBOR. The alternative finance industry is quickly becoming an important and integral part of the UK economy. This innovative, technology-led approach has improved access to finance for SMEs, but also increasingly reflects how those SMEs themselves undertake business. And a lot of them are using increasingly digital channels as their primary route to market. Alternative finance covers a variety of new financing models that have emerged out with or outside of the traditional financial system that connect fundraisers directly with funders, often via online platforms or websites. Now, what we've done with this slide is showing most of those alternative finance models. And I think that if you look at these, basically the thing that would be the most striking is the fact that the peer-to-peer business and peer-to-peer consumer lending are by some way leading the market space. They account for over 75% of the 1.7 billion market in 2014. I think if you were to listen to the press or maybe test your understanding of what crowdfunding was, most people would show or kind of talk about the fact that they would understand it to be in the equity space or donation crowdfunding, where you would maybe get access to a charity, or in the reward space where you would get a product or a service or even a t-shirt to be associated with the company you're investing in. Looking at those figures over the past 3 years, we would envisage that the continued growth of in excess of 150% per annum will remain in 2015, and that the market will grow to some 4.4 or 4.5 billion. And within that, the UK alternative finance market will provide over 1 billion worth of business finance to around about 7,000 SMEs, which equates to just in excess of 2.5% of the gross national bank lending, based on the Bank of England's own stats from 2013. Moving on to the next slide, what is in fact peer-to-peer business crowdlending? It's a debt-based transaction between individuals and existing businesses, which are mostly SMEs, with many individual lenders contributing to any one loan. Effectively, it's back to basics, where savers and investors put money on the platform and it's then used to finance or lend to viable propositions. It's worth pointing out also that there's no capital adequacy required. The platforms are intermediaries, or the kind of broken part of the transaction between the investors and the borrowers. That, as well as the yield opportunities, they have got the ability to be part of the process. So once a loan is available for consideration, our investors have the chance to speak to the owners of the business, find out a bit more about them, and that's a really integral part of the whole operation. Businesses looking to borrow via the platforms, they're most commonly seeking loans for expansion or growth capital, as you would expect, or working capital. And SME borrowers choose business lending platforms because of the combination of speed and ease of use of the model and transparency on pricing, etc. Of the 3,000 or so peer-to-peer business loans analysed for part of this research, the top 3 most funded sectors were manufacturing, professional and business services and retail. And that probably reflects the traffic that we are seeing, with clients coming directly via advisors like yourself or intermediaries, and in some cases they're coming to us even though they've been offered facilities from the bank and still would choose to come to the platform. Most businesses have experienced positive growth since successfully securing a loan, with many borrowers reporting growth in turnover, profit and employability. So, on the other side of that, who invests in peer-to-business crowdlending at the moment? Well, on average, most of the investors are around 50 years old. Just under half of them have 10 years experience working with large corporates, and just under 40% of them have direct work experience working with SMEs. And you'll probably pick up from the top matrix there that the vast majority of the investors are men. So looking into your own kind of markets, it probably reflects the type of investors that you're working with as well. A lot of them typically come from white-collar backgrounds, engineering, accountancy, finance and IT. At the moment, they're primarily based in the south of England, but that probably reflects the first-to-market platforms who have been in the main out of London. And as Sue mentioned, we've got Scotland and the north of England to ourselves at the moment, and we're looking to take advantage of that. When budgeting for lending through the platforms, it's clear that the money is coming from budgets that are set aside for investment or indeed their savings. It's not coming out of their normal monthly income stream. Part of my role is to speak to accountants, lawyers, advisors and people like yourself to talk about the opportunities for retail investors who would probably like to get involved and may consider equity as being too risky. I think the fact that we have a finite model in terms of the money is repaid with interest in line with the repayment profile of the loans on our platform, and we've also created an element of liquidity with a loan exchange, means that a lot of the people that we're speaking to get the model and are happy to take part there. So in terms of my final slide, I wanted to just touch on the regulatory framework and also government initiatives and how they've been looking to open up the marketplace. The whole of the peer-to-peer and indeed the alternative finance space is regulated by the FCA. They took responsibility for the space on the 1st of April 2014. And the regulatory framework applies to peer-to-peer lending platforms and investment-based crowdfunding platforms. The FCA don't regulate other forms of crowdfunding, such as rewards-based or donations-based crowdfunding, primarily because of the fact that there's no money changing hands or no actual returns generated. The vast majority of the focus for us on the peer-to-peer is on financial promotion. And before investing, consumers need to understand the due diligence, and we'll hear more about that from my colleague Ian Cunningham in a second, the level of risk to which you are exposed, the value for money and the investment returns after charges, taxes and allowance for defaults. On the other side, made mention of the British Business Bank. This was an initiative championed by Vince Cable back in 2012, and it was taking into account some of those structural issues that we mentioned earlier in the webinar around capital adequacy and availability of funding for businesses. And they've put out in excess of £500 million out to promote additional finance to SMEs. And part of that initiative has been to place money directly onto the peer-to-peer platforms to facilitate lending to the wider marketplace. And we're looking to be part of that process going forward as well. In terms of the government, what they've recognised that we are facing continued benign economic conditions where we've got low interest rates, and also the opening up of the marketplace for pensions and ISAs. And what we're beginning to see is that you have picked up things like the first £1,000 of interest gains from savings or investments or peer-to-peer from next year will be tax-free, albeit capped at £500 for higher rate taxpayers. And there's also a consultation period in place at the moment around opening up the ISA wrappers for lending to allow them to be directly deployed onto platforms, which will mean that the savings and the interest gained on that will also be tax-free. So exciting times. I think what we've identified is that the marketplace is buoyant, it's growing apace, it's taking the place of traditional sources of finance, but it's also offering a good alternative for retail investors to consider this for the first time as an asset class. Now, all of this only works on the basis that there's a trust element and they maintain the kind of credit quality that we're looking at. So I'm going to ask my colleague Ian Cunningham now to explain a bit more about that aspect. Thanks, Ian.
Thank you, Fraser. By way of my personal background, I have over 40 years banking experience, mainly in the SME market space. Most of my career was with the Royal Bank of Scotland, with the last 13 years of my time with RBS as the head of the Commercial and Corporate Credit Department. I also sat on the bank's UK and global credit committees, and I do put my hand up to some of the things that have happened over the last few years. At the time, RBS had approximately 45% of the SME marketplace in Scotland. I therefore consider that I have a wide and extensive knowledge of the various sectors SMEs operate in and what makes them tick. I'm a fellow of the Institute of Bankers, and together with my colleagues in the credit department, we have over 100 years of banking experience. In fact, our collective experience is a cornerstone of our credit process. Why is it so important? For borrowers, it's essential that they know their application is being assessed fairly by people who are experienced and appreciate the dynamics of how an SME enterprise works. For lenders, investors, they require the comfort and confidence that the credit assessment process is robust and the risk band allocated to a loan reflects the risk in terms of pricing. This enables them to make informed decisions that they can trust in terms of their own risk appetite. The slide before you represents a 6-stage process that we take when evaluating a loan proposition. The next slide covers the initial criteria and the evaluation of financial information. To enable us to undertake a robust evaluation, we need to see a track record of performance. Accordingly, we're looking for businesses that have been trading for at least 2 years and have a turnover of sales of approximately £100,000. If the business does not meet these first 2 criteria, then we do not continue with the application. We do, however, enter into a dialogue with the applicant to see if we can provide advice on what steps might be available to them. We do this to create a relationship. You never know when they might come back to you if they subsequently meet the criteria. In terms of financial information, as indicated previously, we request the last 2 years' accounts to be provided, as this potentially gives us a 3-year history of the business. Given this information by its nature is historic, we generally also ask for up-to-date management information. From this information, we can make an informed assessment of the cash being generated by the business. Ability to repay is a major aspect of the assessment process. Using our affordability model, we can work out existing cash generation, and from this, we can then model future cash generation based on historic and predicted trends. We also factor in the new debt and the term of the proposed loan, which in turn identifies the capacity of the business to service both the existing and the new debt being requested. In addition to this, we look at key trends such as turnover, gross margin, net margin, and key ratios such as interest cover, gearing, and the current ratio. This often leads us into a dialogue with the borrower to enable us to fully understand the dynamics of their business. We also ask for the last 3 bank statements for the business. It's amazing what you can learn from what's going through a bank account. Finally, depending on the size of the business and the purpose of the loan, we may seek a business plan or ask for projections to underpin the information available to us. This enables us to conduct a comprehensive assessment of the overall situation. Moving to the next slide. In terms of independent credit checks, we use the services of a company called CreditSafe. They offer a similar service to the likes of Experian, and while we record their credit score on the platform, we do not incorporate it into the evaluation of our own risk score. It does, however, provide us with a comparison, but we like to think our assessment model is more robust. Where it is wholly relevant for us is the information it provides in terms of credit searches, both on the business and the individuals behind the business. This helps us build up the profile of the directors and the major shareholders, and whether or not there are any existing security been taken or previous credit defaults, such as county court judgments. Once we have completed our assessment of the financial information and conducted the credit searches, using our own in-house expert lender model, we calculate the risk band for the business. This assessment incorporates our view on the sector the business operates in, The competitiveness of the sector, the barriers to entry, and the length of time the business has actually operated in the sector. A key element of our assessment is our view of the management team, their expertise relative to the sector, and the length of time they've operated in the sector, e.g., have they been around long enough to survive a recessionary period. Some of this information is obtained from the application, some is from our own research process, and the rest from conversations we have with the borrowers. They say you can't teach an old dog new tricks, but with the internet, we have a whole new medium available to us with our evaluation process. The quality of our business's website is potentially an indication of how switched on the management team is. Google Earth Street View enables us to see where the business operates from, and we can actually look at where the owners live and make an assessment as to the value of their property, which in turn helps us with our assessment of the value of their assets. Once all this information is assimilated and fed into the expert lender model, we take a view on the value of the security available to us and then calculate the risk band. The risk band in turn drives the pricing model, with our top rated credit, A+ rating, equating to a minimum rate of 5.95% through to a C+ rating, the lowest we will go to, attracting a rate of 12.25%. These are the minimum rates, as it is the lender investor who actually determine the eventual rate offered to the borrower. In terms of security, like most lenders, we look for two sources of repayment. And while the first source is the ability to repay, which is absolutely key, in case something unforeseen happens, our second exit is by way of the security we take to underpin the loan. In the case of limited companies and limited liability partnerships, a bond and floating charge in Scotland or a debenture in England and Wales is taken. If considered necessary, a guarantee is taken from the directors or third parties who are willing to support the business. As indicated previously, an assessment is carried out to ensure that the guarantor has sufficient worth to meet the obligation. To achieve this, we seek an asset and liability statement to be completed. If we are lending to a sole trader or a partnership, where a guarantee is usually not required, given the respected individuals are personally liable, we still assess their net worth to ensure that they will be able to repay the loan if the business failed. Finally, to complete the process, we undertake a series of identification checks on all borrowers and significant shareholders to ensure that they are who they say they are, and this helps us with the prevention of fraud. To summarise, therefore, the credit process. The typical borrower we're seeing is generally a business owner who has been operating for 2 to 3 years. They will have been using their own capital to establish a business and now looking for working capital to enable a business to grow to the next level. Many have no relationship with their bank other than from transactions, and rather than approach their bank, they're happy to look at alternative funding for support. For our investors, as indicated at the outset, it's imperative to them that we demonstrate that our credit underwriting is robust. While I'm not saying I used to lend off RBS's balance sheet in an unjudicious way, when you know that the deals that we're putting on the platform are funded by investors' hard-earned money, it adds a whole new dimension to the assessment process to ensure, as far as possible, you're getting it absolutely right. I'll now pass back to Sue.
Thanks, Ian. So to summarise, Fraser's given you a brief overview of the crowd-lending market and where crowd-lending sits within the context of alternative finance more generally. And as you just heard, a very good summary of our credit assessment process. As an organisation, we feel like we're making great progress. We're part of an expanding market that's increasingly mainstream, that offers a viable alternative asset class to investors. We've got a robust platform which is flexible enough to allow for market development, such as the ISA that Fraser mentioned that will be coming hopefully later this year, early next. As mentioned, though we operate in a regulated market, we seek to offer risk-adjusted returns and the borrowers access to capital. With over £1.4 million of loans to date and over 770 investors signed up, we really feel that we're well on our way to achieving our goals. Thanks for listening. We'll now move to the Q&A. I'll first have a look to see if we've got anyone who's put any through on the chat, and then I'll open up the lines to use to ask any questions. Right, so we've had a question through about protection of money. So if I've got money in a bank and it's protected, so what's the situation with crowd lending? Fraser, can you pick that one up?
Yeah, at the moment there's something called the Financial Services Compensation Scheme, and that covers deposits made by private individuals and small businesses to any authorised firms. And they're protected up to a compensation limit of £85,000. Now, the scheme doesn't stretch to the alternative finance space at the moment, but the regulatory framework is very much in its infancy. And what we've done voluntarily is just basically allowed for an element of default in the actual structuring of the pricing we've got there. So we factor in a small default rate across the whole of the book, and that's reflected in the pricing there. But we're more than able to respond to the regulatory space in terms of implementing any requirements as and when implemented by the FCA. Okay.
Thanks, Fraser. Right, we have a question in from Hamish Malcolm. Any examples of a business which is borrowing from a bank, moving this to LendingCrowd? Ian, do you want to comment on that?
We haven't actually got any examples of refinancing existing bank borrowing debt at the moment. Most of the cases are where either they haven't even approached the bank because, as I said earlier, there's been no relationship, or they've approached the bank and they don't meet criteria for additional funding. I think this is where, from our perspective, we can look at each individual case on its own merits, whereas increasingly probably in the banking world, if they don't hit the actual policy at the time, no matter how good you might be, if you don't perhaps hit the, say, EBITDA ratio, then you're not going to get the funding. And we certainly have had examples of that where we've actually been able to provide the funding that banks have not desired to enter into.
Okay, thanks, Ian. I've had a question here around what are the kind of options once you come onto the platform to invest. I'll handle that one. So there's several. So firstly, there'll be the new loans that are on the loan market. So as an investor, you can go on and review all the loans that are on the loan market, look at the risk assessment that they've been given, look at all the other material. A lot of the things Ian mentioned as the things they look at will be available to you on the market to look at. You'll be able to enter into a dialogue, ask questions of the borrower through the platform and have those answered. So you can, and then place a bid on that particular loan for an amount of money at an interest rate. And once that loan is closed, then that would come to pass. You can also buy loan parts. So as an investor, if you wish to diversify or remove some of your money from the platform, you can sell parts of your loans on the loan exchange. And as a new investor, you can come in and buy those loan parts. So if there's a company or borrower that perhaps you're interested that borrowed money, say a year ago or whatever, you can go on and buy a loan part. We also have an auto bid facility, which will automatically place bids on your behalf within a predefined set of constraints that are controlled by you. And coming soon, there will be a package product which will allow you to select an interest rate in a number of years to get the return on your investment that way. Right. No other questions have come through on the chat, so I'm going to try and unmute all your lines to see if there's anyone out there that's got any questions they want to ask. If you could, if you're not answering or asking a question, if you can keep your own lines muted, and if you do want to ask one, could you give your name, organisation, and state who you'd like to direct the question to, that would be great. So anyone out there would like to ask a question?
Hi there, Hamish Malcolm from the Highland Jury here. Just a general one, I suppose, for Ian, Fraser, whoever. In terms of minimum deal size you would put on the platform, what would be the smaller amount, would you think?
Well, for limited companies and limited liability partnerships, we're not constrained by the Credit Consumer Act, so we can do from anything, I suppose, but typically maybe 10 to 20,000, I think, would be the sort of minimum amount we'd be looking at. In terms of, obviously, those constrained by the Consumer Credit Act, it's probably 25,000 and above. But typically, we're seeing deals anywhere from 50,000 up to 100,000.
Thanks, Ian. Cheers. Thanks.
Anyone else like to ask any questions? Okay, had one other earlier about how do the actual repayments work in terms of interest and capital. Fraser, do you want to handle that?
Yeah, in terms of, as Sue alluded to earlier on, you bid for an amount, and at any given time you've got money on the platform invested in a variety of loans, and the capital and interest is repaid on a fractionalised basis in line with the repayment programme for the loan as well. So you would get your money back with interest over the period commensurate to the actual loans that are invested in there. So relatively straightforward, relatively transparent model. We charge a 1% fee annually for investors, and that's factored into that equation as well. But I think what we alluded to is that we'd be absolutely key to creating an element of liquidity in the marketplace by introducing the loan exchange, so that we have the ability to potentially get some of your capital back. And I think that's an attractive asset that probably differentiates from a lot of the people that have been investing in equity where there's no natural exit point on day one.
I think the aspect of liquidity is quite important as well, because obviously the deals can go up to 5 years, but if you don't want to be linked in for 5 years, you can then use the loan parts as a mechanism to effectively exit a transaction a lot quicker. The other key part of the loan parts, in terms of new investors, it does give them access to deals that we've already underwritten and obviously have a track record therefore in terms of repayment, so that for a new entrant that might be an early source to go and have a look at those. As I say, they will have a track record, and touch wood, all our deals are performing okay at the moment.
It's worth pointing out, just with regards to that the minimum amount you can loan onto the platform is £100, but you can bid as low as £20 for each of the loan parts there. So it's quite a low entry level point, and we're able to kind of get people engaged at that level before they maybe commit to putting more funding on. So.
Thanks, guys. Any other questions from anyone out there listening? Okay, well, we'll close the call now. Oh, is someone coming in? No. Right, we'll close the call now. Thanks very much for joining. We will make this available on our website so that you can share it with other people. But if you'd like further information, please feel free to contact either Ian, Fraser, or myself. Our emails are there. Follow us on LinkedIn and Facebook and Twitter if those are things that you like doing, to keep in touch with the stuff that we're posting about what we're doing and what else is happening in the overall alternative finance, crowdfunding, crowdlending market. Thanks again for your time, and speak to you again soon. Goodbye.
Thank you.